Hello and welcome to our new investment strategy update. Has the recent market turbulence dramatically altered the investment outlook? Markets have swung from concerns about overheating a few months ago to US recession worries. We favor a more middle ground. US growth and consumption are slowing and the labor market is easing, but the economy is still in decent shape. Jobs are key to the Federal Reserve's outlook. While hiring is slowing, layoffs are contained. Real wages remain positive, supporting the US consumer, whose resilience may ensure a soft landing. With inflation nearing its target, the Fed will now move to ease policy. We expect an accelerated path towards more neutral stance with cuts at each meeting starting September, showing markets that the Fed has not fallen behind the curve by not cutting in July. The US elections have already taken center stage. The presidential race now looks too close to call, although a divided Congress is more likely if the Democrats win and a united Congress in a Republican victory. Tariffs would be the key variable under a Trump presidency. These would be inflationary and halt Fed rate cuts sooner. If Republicans take the presidency and both houses, nominal growth could also be higher. This may be the most positive scenario for equities and the dollar, with gains for banks and the defense sector in particular. A Harris administration would imply greater continuity. In this case, we see Fed cuts until mid-2025 towards a neutral level of around 3.5%. A Democratic win could favor more defensive stocks, although efforts to reduce healthcare costs may weigh on the sector. While a Trump presidency could shift dynamics in the Middle East and Ukraine, neither presidential candidate shows appetite to reduce the federal deficit or to alter a tough stance on China. Barring external shocks from geopolitics or the US election and a tariff trade shock, 2025 should see growth near trend levels as long as central banks indeed cut rates to neutral. Let's now turn to Michael to find out how this outlook affects our investment strategy and House view.
The recent turbulence in markets is a powerful reminder of how fast market tides can turn. Rotation from tech and growth stocks, recession concerns, and the US elections twist through markets off all-time highs, only to rebound swiftly and strongly. Faced with many uncertainties, we have maintained our balanced approach, anchoring our strategy in our strategic asset allocations. This has helped our portfolios weather the storm. So, what's next for investors? A soft landing, easing monetary conditions, and solid earnings growth are supportive for risk assets. Stock markets can reach new highs and outperform bonds, but geopolitical and US election risks urge a degree of caution. That's why we keep equity allocations at strategic levels for now, with a preference for UK stocks where growth expectations are rising. Overall, we remain attentive to selective buying opportunities. In fixed income, we maintain our exposures at strategic levels. We still see a case for buy and hold investors to lock in today's high sovereign bond yields. In credit, we prefer dollar-hedged European to US corporate bonds. During the recent market turmoil, credit spreads only widened modestly, which means that corporate fundamentals are solid. In FX markets, the dollar's yield advantage and haven demand from geopolitical risks will keep supporting the US currency. But the dollar's biggest gains may be behind us as the Fed eases policy. We remain cautious on the euro and sterling and expect the yen and Swiss franc to appreciate against the US dollar medium term as the Fed loosens. Overall, investors need to stay vigilant. Geopolitics and November's US election promise a volatile 4 months. A disciplined approach to investing through major uncertainties can add value to portfolios. We remain alert and poised to take advantage of new investment opportunities as market tides shift. Thank you for watching.